A very good afternoon. You're watching the newsroom right here on ET Now. I am Ajaya Sharma. Very sharp recovery coming in. In fact, the small cap, mid cap, and the rise or the rebound of small cap, mid cap is the main story to watch out for right now. Barely a percent away from fresh all-time highs. So completely recovered from the Amphi stress test related nervousness, SEBI commentary related nervousness. The last 1 month of the small cap, mid cap will come up on your screen now. That is the big story. Apart from that, telecom stocks are doing phenomenally well, led by Vodafone Idea, of course, and Bharti. Reliance is the only company which houses a large telecom, and that is not shot back. But otherwise, the telecom space, Indus Towers, Star Tele, Tejas Network, all of them are doing very well. Trideep Bhattacharya is now joining us to talk more about the markets. Trideep, good afternoon. Thank you so much for your time. Let's start our discussion with telecom today, because there is a big re-rating happening. People are now thinking that from almost going towards a two-player space, we are back to three-player space, and probably BSNL, MTNL will be revived soon. So it will be a nice, vibrant four-player space. Did you have telecom exposure in your portfolios, and how are you looking at the way things are panning out there?
So, hi Ajay, good to be on your show as always. And I would say that yes, we have increased over the last 3 months or so. We have increased our position in telecoms. While the overall long-term dynamics of the business, which is capital guzzling and return ratios have been not so great in the past, has been there. But every sector goes through a phase where the sector sees a bit of tariff-related reconciliation. What we have seen over the last 2 or 3 years is that tariffs have been particularly weak and driven by one of the players. I think now that we have a bit of more investments coming in this space, and now that the third player will come to play in the near term, we could see a bit of pricing realignment from a tariff perspective from the sector. I am talking about over the next 3 to 6 months, and I think that would be an interesting sort of play from the sectoral standpoint. That's one. And secondly, of course, while people had completely lost hopes on a particular player in the market, seeing that player revive also kind of revives a bit of interest in the sector. So the second one is stock specific, but the first one being sector specific. The sector specific part is actually what is re-rating the sector today, as in a bit of tariff hike is always good for all the sector players.
Trideep, what are your thoughts on the way earnings season is panning out right now? No big negative surprises, but no big wows as well. Have you looked at the details of at least the first phase of numbers so far?
Yeah. So I think overall, I would say that from the companies that have reported so far, financial companies have reported their growth numbers. Growth numbers have been in line overall. I think the NIM declines have been slightly lesser so far. We will see as more companies report overall, which is why the markets have been holding on to it. If you look at industrial companies, from manufacturing companies, ordering numbers that have come through, they seem to indicate that the business momentum continues to be robust overall. The consumption numbers have been weak. So I think if you look at the last 2 or 3 quarters, the script of the market has remained by and large in similar lines. And that is what we have seen so far as well, which is why the market is kind of gradually chugging along, given the fact that earnings are still intact. And overall growth rate continues to be broad-based, not just amongst large cap but among mid and small caps, which is why that's kind of keeping the mid and small cap, so to speak, share prices also reasonably buoyant in the near term.
Right. Pradeep, what are your thoughts on the way cement space is trading at right now? We saw Adani Cements recently give out a guidance of aiming to reach 125 MT by 28. We saw Grasim and the group, Ultratech Group, already hit that mark, and now they are aiming at 185 levels. And then there are smaller companies and slightly bigger ones, Ramco, Shree Cements. I want to understand that cement sector pricing has not gone up very meaningfully over 10 years now because of over capacities, etc., stuff like that. How long, when every commodity is getting re-rated, how long can cement trade in the same valuations it used to? Cement, actual cement per bag I'm talking about. And do you think next 5-7 years, the way demand is coming, domestic demand, there could be a case of further re-rating of cement stocks? And what's your call on it?
Very nuanced question. So we are broadly across portfolios neutral to marginally overweight cement. And our structural call over the medium term is in sync with what's similar to what you said, which is that overall, if we do see a manufacturing-led buoyancy in the economy, domestic economy, then the cement sector would see a positivity over a period of time. There are some short-term dynamics which are also playing out in the sector, which is worth understanding from taking a view. The first is when Adani announced, or one of the announced their entry into the space, and one of the other kind of Grasim also kind of talked about their aggression. There was an incumbent expectation that a lot of capacity addition will come through, and that would kind of spoil the dynamics of the sector. But what we have seen so far, a year from that intention that got announced, that people have been a lot more sanguine with regards to capacity addition. On top of that, actually, there is increased case of consolidation within the sector. Consolidation generally leads to better pricing scenario over a period of time. But as and when the event happens, the pricing kind of behaves a little awkwardly, which is where we are right now. So I think on net balance, what I'm saying is, if we look at from a 2 to 3 year perspective, you would see consolidation in the sector. That would mean better pricing from the players, and the demand buoyancy driven by the manufacturing-led growth should mean an augur well for the sector overall. That kind of broadly summarizes how we are positioned in the sector.
Okay, which space have you started buying most or adding positions last few months? I want to know, areas which look comfortable on valuations and good earnings growth prospects.
So over the last 3 to 4 months, we have actually from underweight we have gone neutral IT services. Overall, whatever, not to say that we will expect great growth rates in the near term, but I think over the next 2 to 3 years, the earnings is broadly bouncing around the bottom. We think that when next year global growth kind of picks up after the bit of weakness that we have seen, whenever we see, then you would see this sector starting to do well. Until the time, it's basically we have from a demand perspective, things are not going further south. So that's one area where we are in a gradual accumulation phase, I must admit. That's where we are. That's one. Second, if you go over the last 3-6 months, we have continued to add on the power side of things. We think that versus the demand, supply is meaningfully short. So all the companies which are exposed to the power supply chain would see meaningful earnings upgrades. So in some of those names wherever there have been kind of QIBs or ability, or there has been any dips in the market, we've been accumulating that space quite meaningfully. And the third one I would argue is on the real estate side, particularly on the indirect side. In my opinion, over the next 12 to 18 months, we are at the moment seeing buoyancy from numbers of builders. I think over the next 12 to 18 months, as the projects get more mature, you will see the tile makers, the sanitary ware makers, and those kind of ancillary players of the sector also stand to benefit over time. So niche sectors, niche areas, but those are the areas where we are keeping our hunting glasses on.
I want to talk about power. You said you've added. I want to understand which end of the value chain in power have you added? Is it wires and cables? Is it transformers? Is it generation companies, legacy, or the new age? What exactly are power financiers?
So we started off with the wires and cables. And at the moment, we have exposure practically to every end of the supply chain, including power financiers, including power generation, and to a certain extent on the companies which provide nuts and bolts to this space as well. We think that given where supply demand scenario is over the next 2 to 3 years, this demand actually, or this gap is actually going to worsen before it gets better. And I think all the elements of the supply chain would stand to benefit. On the transmission side, we have probably not added as much, but barring that, we are probably practically present there in all ends of the supply chain by now.
Okay, and even on the real estate side, there is a mixed opinion coming in now that prices have peaked out and volumes may also peak out in the next 6 months, the way huge amount of inventory is coming in the system. Where to your mind, do we stand as far as the realty cycle is concerned? And what would happen to realty stocks in this way?
So, in my opinion, we are in the middle of a 5 to 7 year upcycle in real estate. In that context, we are somewhere in the middle. If you look at till about 6 months ago, the inventory side of May or June, then we could see a meaningful amount of thrust in this space as well, and that combined with the fact that the sector has gone through almost a 10-year consolidation post RERA and various different debacles that the sector has gone through. If you ask me, I think as evidenced in the recent results of some of the real estate players, you could see this buoyancy play out for longer than otherwise. This is a very India-specific point, Ajay. It's worth noting that in our friendly neighborhood, China, obviously, we have seen Chinese real estate go through its own issues. Likewise, in the United States, we have seen the rate increases having some impact there as well. So this is very bottom-up, homegrown, post-consolidation demand in real estate, which is kind of holding the sector through. And mind you, at some point over the next 12 to 18 months, whenever there is a rate cut, this is one of the sectors which would stand to benefit from there as well. So from what I see and what I read, I haven't seen or spotted weakness coming through. If anything, I think the builder inventories are getting taken out sooner than what people think.
All right, Trideep, we'll let you go on that one. Thanks so much for joining us on the show today.
Pleasure.
We'll take a short break.